Welcome to today's Explainer. Look, we're diving right in today because we're tackling a topic that honestly, most of us would literally rather do anything else than think about. It's definitely not light dinner conversation, but it is absolutely vital for your financial foundation. Today, we're breaking down the 5 fatal mistakes of life insurance. We're going to look at exactly where millions of people go wrong and, more importantly, how you can avoid these critical pitfalls to protect the people you love most.
I want you to really sit with this question for a second. If something happened to you tomorrow, would your family be financially okay? Right? It's a stark, super uncomfortable question. It kind of forces us to confront a reality we usually shove straight to the back of our minds. But asking this question right now, while you actually have the power to do something about it, is hands down the most important financial step you can take.
And here's the harsh reality of it. For millions of Americans, the honest answer to that question is simply no. They wouldn't be okay. But the reason why might actually surprise you. It's usually not because they don't care or because they haven't thought about it at all. It's almost always because they've fallen into one of 5 specific traps. So identifying these gaps in our financial armor is huge. Let's start dismantling these mistakes one by one.
All right, mistake number 1, the procrastination trap.
This one's all about timing and that incredibly common assumption that life insurance is just something you can figure out, later. But it turns out there are dual penalties for waiting. We often think of life insurance as this static product you can just grab off a shelf whenever you're ready. But age and health changes drastically shift your options. First off, we've got the age factor. The older you get, the more expensive your premiums become. It's just a fact. But that second point, that's the real hidden danger. Health changes. If you develop a medical condition while you're putting this off, you might not just face higher rates, you run the risk of not qualifying for the best rates at all. You are essentially betting your family's entire financial security on your continued perfect health.
So this requires a major mindset shift. The best time to lock in a low rate was years ago, but the second best time is today. Seriously, don't dwell on the fact that you didn't do this in your 20s or early 30s. The mechanics of life insurance mean that right now, literally today, is the youngest and potentially the healthiest you will ever be for the rest of your life. It's the best time left to take action.
Moving on to mistake number 2, the employer coverage illusion.
This one creates a massive false sense of security for so many working professionals. A lot of people just assume the coverage they get automatically from their job is totally fine. You check a little box during onboarding and you feel covered, right? But it turns out most employer policies only cover 1 to 2 times your annual salary. Now, at first glance, receiving a lump sum of 1 or 2 years' worth of your salary sounds like a lot of money.
But let's look at what that money actually has to do. That tiny multiplier has to cover massive, long-term gaps. We're talking about years, potentially decades of mortgage payments. We're talking about childcare costs, which, let's be real, are astronomical these days, plus everyday daily living expenses. 1 or 2 times your salary gets swallowed up by those expenses incredibly fast. And here is a crucial warning. This is the real kicker. If you leave that job, whether you quit, get laid off, or retire, that coverage usually disappears right along with your employee badge. You don't own it. Your employer does.
Next up, mistake number 3, choosing the wrong policy. Once people realize they actually need their own independent coverage, they often run headfirst into a giant wall of confusing industry jargon. When we cut through that jargon, we generally find 2 main tracks: term life and whole life, and they are absolutely not the same thing. Term life is exactly what it sounds like. It covers you for a specific term, maybe 10, 20, or 30 years. It's usually much more affordable, and frankly, it works incredibly well for the needs of most families. On the flip side, whole life is permanent. It's more expensive, sure, but it builds cash value over time. Now, neither of these is inherently wrong, but choosing one without actually understanding the difference between them, that's the mistake. And it's a mistake that can literally cost you thousands of dollars in the wrong premiums.
Okay, mistake number 4, underestimating your needs. So, let's say you have the right type of policy. How much do you actually get? This is where the research shows so many well-intentioned people stumble. They know they need insurance, so they just kind of guess a random number out of thin air. They say, oh, let's get 50,000, or 100,000 sounds like a nice, round, big number. They do this completely without doing the actual math. And again, $100,000 sounds like a huge amount of cash in a vacuum, but in the context of replacing a lifetime of provision, it falls dangerously short.
So the absolutely crucial point here is looking at what the experts actually recommend. Financial experts often suggest using 10 to 15 times your annual income as a starting point. Yep, you are reading that right, 10 to 15 times. Now, I know that sounds like a massive, almost intimidating number compared to that tiny 1 to 2 times you get from work.
But when you actually break down what this math has to protect, it builds a solid wall of security around your family. See, we aren't just paying for immediate final expenses here. This money is meant to replace years, perhaps decades, of your lost income. It's meant to ensure your family's home isn't foreclosed on, so the mortgage can still be paid. It's meant to secure your children's future, keeping their educational and life goals perfectly intact, even if you aren't there to fund them. When you factor in all of that long-term stability, 10 to 15 times your income makes perfect logical sense.
Finally, mistake number 5, the set it and forget it flaw. Now, this one's really tricky because it actually catches people who did everything right the first time. The reality is, life just doesn't stand still. Think about these major milestones. Number 1, you got married. Number 2, you had a kid, or maybe a second or third kid. Number 3, you bought a house, taking on a massive new chunk of debt. Every single time you hit one of these milestones, your financial footprint expands, your responsibilities grow, and therefore your life insurance needs just changed entirely.
But the problem is, most people never go back to actually review their coverage. A policy that made perfect sense 5 years ago when you were, say, renting an apartment with no kids, well, that might leave a huge, dangerous gap today now that you've got a mortgage and a growing family. Outgrowing your policy can honestly be just as risky as not having one at all. You have to treat this as a living, breathing part of your financial plan.
So let's talk about the solution, the 5-minute fix. Okay, we've covered some pretty heavy, sobering truths today, but I want to pivot for a second because this doesn't have to be overwhelming. I really want you to take this thought to heart. 5 minutes of planning today could protect your family for decades. Life insurance isn't exactly fun to think about. Nobody wakes up excited to map out worst-case scenarios. But contrast a tiny 5-minute investment of your time today just to calculate your needs or reach out to an expert against literally decades of unshakable financial security for the people you love. It's pretty much the greatest return on a 5-minute time investment you will ever make.
So, what's your next step? Look at the coverage you currently have, do the math on the coverage you actually need, and please don't put it off until tomorrow. If this explainer helped bring some clarity to a pretty complex topic, consider subscribing for more simple, no-nonsense finance breakdowns just like this one. And remember, this is purely educational content designed to give you a solid framework. Always speak with a licensed insurance professional to find the exact right coverage for your specific situation. Thanks so much for focusing in with me today, and I'll leave you with this. Knowing what you know now, are you ready to turn that vulnerable no into a confident yes for your family's future?